Can you see the file I'm sharing, class?
Yes, sir.
Okay, we'll have problem 6-3. Innovative company manufactures and sells electrical generators. On January 1, 2021, the entity sold an electrical generator costing 700,000 for 1 million. The buyer paid 100,000 down payment and signed a 900,000 non-interest bearing note payable in 3 equal installments every December 31. The prevailing interest rate for a note of this type is 12%. The present value of an ordinary annuity of 1 for 3 periods is 2.4018. Plus, I do not have the luxury of time to teach you how to solve for these annuity factors, class. I hope you already know how to solve the PV factors. But supposedly for financial accounting class, the present value factors should be given already. The subjects that will require you to compute for the factors class would be in your finance, in your management accounting subjects. But for intermediate accounting, ideally the factor should already be given to you. The 2.4018 class represents the factor that will convert a series of cash flow, and in this case, three periodic payments that will convert it into its present value, that will convert the 3 cash flows into its value as of today. Because again, the assumption in accounting, in finance, is that future cash flows class are not as valuable as its equivalent today. If you have 100,000 pesos 1 year from now, the value of that cash flow that you will get 1 year from now is not 100,000 as of today. Because if there's a period of time that will lapse class, the presumption there is that that amount will already include interest. For you to get 100,000 1 year from now, you do not need 100,000 today, because you will only need a lower amount for you to be able to generate or come up with 100,000 1 year from now. There's always an assumption that money will earn interest class. So if you're expecting to receive 100,000 1 year from now, its value today, if converted to its present value, will not be 100,000, because the 100,000 1 year from now will include an interest that could be earned within the period of 1 year. So the objective here is to convert the cash flows class to their present value, to their value today. Okay, so that is why, even though the selling price class is 1 million, okay, and we have a receivable of 900,000, our receivable is only 900,000 because there was a down payment of 100,000. Okay, and these 900,000 class are to be paid in 3 equal installments of 300,000 each. So every year for the next 3 years, we will receive 300,000 for a total of 900,000. Okay, but the value of that 900,000 class, which we will ultimately get within a 3 year period, will not be 900,000 if reckoned today. We expect that the 900,000 that we will be able to receive in total for the next 3 years will not be worth 900,000 today. Because again, there's a presumed inclusion of interest in those amounts. Okay, so and that presumption class will apply here because the note is non-interest bearing. Even though we say that it is non-interest bearing, the consequence is that the face value of the payments class will just include the implied interest. It's different if it was interest bearing class. The face value of the note will already be its present value today. Why? Because the interest that could be earned will be added to the face value. But here, the total that we will receive, if we're dealing with non-interest bearing, the total amount that we will receive will be the face value. And since we do not accept the term non-interest bearing in accounting. We do not believe that money can be given for free. So to remedy that, we presume that the face value will include an interest component. Okay, but you have to be careful, class, in using your PV factors. Uh, just like in this one, the PV factor is for an annuity. So you should not multiply 2.4018 with the 900,000. You multiply 2.4018 with the annual periodic payment, class. Okay, and in this case, the periodic payment would be 300,000. Okay, I hope everyone understands where we got 300,000 class. Okay, the balance is 900,000 and it is to be paid in 3 equal installments. Okay, so the first thing that you should avoid doing is to multiply immediately 900,000 with 2.4018. Okay, and if you do that, class, okay, it should be very easy for you to know that you got it wrong, because when you multiply 900,000 with 2.4018, you would get around how much is this? Uh, 20 2,300,000, and that should be around 2,300,000, and that should be wrong, because again we say that the present value, the value of future cash flows as of today, should be lower than its face value. So the amount that we should expect should be lower than 900,000. And if you multiply 900,000 with 2.4018, you would get around 2.3 million. So that should be wrong. So the correct procedure here is to multiply 300,000, our periodic payment, our periodic cash flow, with 2.4018. Please help me here, class. How much is 300,000 times 2.4018?
720,540, sir.
Okay, thank you. So what does this mean? The present value of 300,000s that we will get in the next 3 years, class, its value as of today would be 720,540. Okay. But how much will we ultimately receive? 900,000. So what does that mean? What does the difference represent? It represents the total interest that we will earn in the next 3 years. If the customer, class, will pay us 900,000 in the next 3 years, but we know that the value of this 900,000 class is only 720,540, then the difference there will represent the interest that we will earn from this transaction in the next 3 years. Okay, and the difference between 900,000 class and 720,540 would be 179,460. 179,460. So at the date of the transaction, class, the 179,460 would still be considered as an earned income. It will still be considered an earned interest income, because from the name itself, class, this amount is not yet earned. Okay, how is interest earned? Through passage of time. So from the day of the transaction, class, on January 1, 2021, we know that in the next 3 years, we will earn 179,460. But as of today, as of January 1, 2021, we have not yet earned this interest. Because again, interest is earned through passage of time. So in our books, class, the 179,460 will be recognized first as an unearned interest income. In the presentation of the financial statements, class, the unearned interest income account will be presented as a liability, class. But in the end, this would actually be charged against the notes receivable account. Okay, what do I mean? From this transaction, we will have a debit to our notes receivable, class, in the amount of 900,000. And then we will have a credit to our unearned interest income in the amount of 179,460. Okay, ordinarily unearned income, class, or unearned revenue will be presented as a liability. But since this is related to a notes receivable, class, they would be presented net of one another in the statement of financial position. So in the balance sheet, class, in the statement of financial position, it is the net amount that will be presented for our notes receivable. So when you look at the notes receivable line, class, you will not see there 900,000. You would see there 900,000 less 179,460. So the amount that will be presented in the statement of financial position will not be 900,000, but will instead be 720,540. or as we have computed earlier, the present value. Because again, that's the rule. Notes receivable are to be presented at their present value. Okay, notes receivable are supposed to be presented at their fair value, and their fair value will be their present value. Okay, so again, if you are asked, as of January 1, 2021, at what amount will the notes receivable be presented, assuming we will prepare financial statements on January 1, 2021? It's not 900,000, but it should be presented net of the unearned interest income. So the answer would be 720,540, which is 900,000 minus 179,460, or simply the present value of the future cash flows class. Okay. By the way, what are the requirements here? I'll just prepare the journal entries. Okay. So as of January 1 class, our complete entry would be definitely be January debit to cash. Okay, because in this transaction on January 1, 2021, we'll receive cash in the amount of 100,000. And as I mentioned earlier, we will recognize the notes receivable in the amount of 900,000. So our debits would be cash 100,000 and notes receivable 900,000. Our credit class would be an earned interest income in the amount of 179,460. Okay, and we could say that the balancing figure in our entry class would be our sales, because again, this involves a sales transaction. Okay, so our second credit would be to sales in the amount of 820,540. Okay, but how else can we get the 820,540 class? Okay, if you'll notice class, 820,540 is very similar to the present value. The present value was 720,540. Okay, so how can we solve for our sales price, our sales revenue? You just get all the payments class. You just get all the payments. How much payment will we get from the buyer class? Okay, first we had the 100,000, and second we had the notes receivable in the amount of 900,000. Okay, so you can actually say that the sales price is 1 million. Okay, but why is 1 million not the answer here, class? Okay, indeed 1 million is the total payments that we will get from the client class or the customer. But remember, class, 1 million is composed of the down payment of 100,000 and the notes receivable of 900,000. And in this 900,000 class, not the entire amount represents payment for the generator that we have sold. Okay, remember that the 900,000 includes the imputed interest. Okay, although eventually the 900,000 will be an income on the part of the company class, but it's incorrect to say that the entire 900,000 represents sales revenue. Okay, what do we mean? Because we know that the 900,000 includes payment for the interest, and payment for interest class should not be considered as part of your sales revenue. It should be recognized separately as interest income. So to get the correct sales price then, or to get the correct sales revenue figure, you will have to remove the interest component class. You will have to remove the interest component. Again, ultimately, total revenue that will be recognized by the entity would be 1 million. But it's incorrect to say that the 1 million represents sales revenue. Part of the 1 million, particularly part of the 900,000, represents interest income. Okay, it's important that we segregate the different sources of income class. Okay, I hope you get my point. Ultimately, the 1 million will be an income, a source of an income on the part of the entity. Okay, but it's wrong to say that the entire 1 million represents revenues or income from your sales class. Okay, the source of a portion of the 900,000 income class is from interest. So you will have to remove the interest component. So how much is the implied interest included in the notes receivable class? As what we have computed earlier, it's 179,460. So one way of getting the sales revenue is simply by deducting 179,460 from 1 million. Okay, again, it's simply 1 million minus the imputed interest of 179,460, and you would get 820,540. Okay, alternative solution. Okay, just get the present value of the 900,000. How much was the present value of the 900,000? 720,540 because out of the 900,000, 720,540 represents payment for the generator class, while the remainder represents payment of the interest. Okay, but 720,540 is not enough because aside from the 720,540, we receive payment also in the amount of 100,000. So 720,540 plus 100,000 will give us 820,540. Okay. But personally, class, I just prefer if you simply remove the interest component from the total consideration, class. The total consideration here, the total agreed price here is 1 million. Just remove the interest component on the uh, note class and you will already get the correct sales figure. Now you could ask, why is there no interest? Why are we not removing any interest from the 100,000? Why are we not removing any interest component in the 100,000? Because in this 100,000 class, which is paid today, which is paid in the day of the transaction, includes no interest. The present value of 100,000 today is also 100,000. Okay, there's no imputed interest there because it's not a future cash flow. It's a cash flow that is available today. So definitely, if you have 100,000 today, class, if you ask anybody, the value of your 100,000 today would just be 100,000. Okay, I hope that makes sense. We only remove interest for future cash flows. There is only an implied inclusion of interest only for future cash flows, class. But for payments that are made today, for payments that are made in the present day, whatever is the value of that payment is already its present value. So there's no need to remove any interest component because simply there is no interest that is included there. Okay. So common question here would be how much would be your sales revenue? Okay, as of January 1, 2021 class, this could be a common question. From this transaction, how much will be recognized as sales revenue? And our answer would be 820,540. Second common question for the day of the transaction would be how much would be the total unearned interest income as of January 1, 2021. And our answer would be 179,460. Class, for questions on unearned interest income, class, it's common that you would be asked for, it's common that the question will be phrased, how much unearned interest income should be presented as of, okay? The phrase as of is very common when we are dealing with unearned interest income because as the period progresses, class, the value or the balance of your unearned interest income will fluctuate. Will go down. Okay, it will slowly go down to zero, class. Once full payment is achieved, then your unearned interest income would be zero. Okay, so unearned interest income again is simply interest income that is not yet earned. So through passage of time, these unearned interest income will be considered earned and should therefore be no longer part of our unearned interest income. So it's very important for you to focus on the reckoning date, class. You understand that you are asked how much is the unearned interest income, but you have to ask the question, as of what period am I being asked of? Okay, because depending on the date, class, the balance of your unearned interest income would be different. Okay, but if you are asked on the date of the transaction, class, that only means the question is asking for the initial balance of the unearned interest income, which would represent the total interest income that will be earned from the transaction. Okay, and aside from the January 1, 2021 class, we'll have to prepare an entry at the end of each reporting period to recognize the necessary adjusting entries, class. Okay. On December 31, we'll prepare two entries, class. The first entry would be to recognize the payment because if you'll remember, if you'll read the second sentence or the second paragraph, class, it tells us that the note payable is payable, that bearing note, non-interest bearing note, payable in 3 equal installments every December 31. So every December 31, we will receive payment. Okay. So definitely one of our entries in December 31, 2021 would be debit to cash 300,000 and credit to notes receivable in the amount of 300,000. What's the effect of this entry, class? Our cash will increase, obviously, and it's correct that our cash will increase because we receive a payment of 300,000. Second effect would be our notes receivable will decrease. Okay, remember that in January 1 we recognize notes receivable in the amount of 900,000. Okay, because of the 300,000 payment, it will be reduced to 600,000 after 1 year. Okay, but second entry that we'll have to prepare, class, an adjusting entry that we'll have to prepare at the end of the first year would be to recognize the portion of the unearned interest income that is already earned. Okay, and unlike the illustration in 6-2 class, 6-3 we will have to use the effective interest method. We'll have to use the effective interest to determine our interest income, and it's actually very simple, class. You just multiply the effective interest rate, which will normally be given in the problems. In this case, it is 12%, and you multiply 12% with the previous balance of the uh, notes receivable net of the unearned interest income, or simply multiply it with the principal balance, class. Okay, our total receivable was 900,000, but we know that the 900,000 represents interest and principal. If you remove the interest, the principal component of the 900,000 will only be 720,540. So to get the interest component, class, I'll need your help here, class. Just multiply to determine your interest income for the year. Just multiply 720,000 with 12%. 720,540, multiply it by 12%. I'll need your help here, class. 720,000.
86,465.
Okay, thank you. 86,000. How much was it? 86,000.
464.8, sir.
465.
Let's round it up na lang to the ones place. So 86,465. Okay. So if you'll be, and that is another possible question for this kind of problem. How much would be the interest income for the year? Okay. So common wrong answer for most students, class, who will not use the effective interest method, who will not prepare the amortization schedule, would be to simply divide your 179,460 by 3. Okay, and that should be wrong because the balance of our receivable is diminishing, class. So the interest that you will earn should not be equal in the 3-year payment period. Okay, so it should be always based on the outstanding balance, class. And the outstanding balance was 720,540 before the December 31, 2021 payment. And we expect that the interest for the first year would be the highest, class. Okay, and we expect interest to be lower on the second and the third year. So again, second common question, another common question here would be how much would be your interest income for the year? And your answer would be 86,465, which is simply the principal balance or the outstanding balance for the year multiplied with the effective interest rate of 12%. Okay. Next possible question would be how much is your unearned interest income? How much is the unearned interest income at the end of the first year? Okay. And that should not be difficult to answer, class, because it's very understandable. We have already figured out that at the very start, our unearned interest income was 179,460. And again, we know that the unearned interest income will gradually decline or gradually reduce for every interest that is already earned. And we have also computed that for the first year, we have earned a total interest of 86,465. So all you have to do to get the balance of your unearned interest income is to remove or to deduct the 86,465 from the 179,460. Let me just open an Excel file. So initially it was 179,460. And then we have earned this year the amount of uh, 86,465. 86,465. So the remaining interest that is not yet earned, that we will earn in the next 2 years, would be 92,995. Okay, I hope you have the same figure, class. So if you are asked, although not as common as the other questions I have mentioned, class, if you are asked how much is your unearned interest income as of December 31, 2021, our answer would be 92,995. And these 92,995 would be earned in the next 2 years, class. Okay. But another common question, class, would be how much is the net balance or the net realizable value of your uh, notes receivable as of December 31, 2021. Again, if you're looking for the net realizable value, class, of your or the amortized cost of your notes receivable, it would simply be the balance, the principal balance, minus the minus the uh, principal payments. Okay, but I hope you're already familiar with an amortization schedule, because if you prepared an amortization schedule, you would get the uh, net balance of your notes receivable. Okay, but an alternative solution, class, would be to start with the face value, class. You start with the 900,000, and then you deduct the principal, the total payment, class. How much was paid for the first year? 300,000. And then you deduct the remaining unearned interest income. I hope you're following, class. I hope you're writing it down in your own notes. Okay. So one way, class, one way of getting the uh, net net balance of our notes receivable after the first year, class, would be by starting from the face value of the note, class, deduct the payment that you have received, and deduct also the remaining unearned interest income. They deduct the remaining unearned interest income. So we started at 900,000, deduct 300,000, you will get 600,000, deduct the remaining unearned interest income in the amount of 92,995. The net balance, the net amount that will be presented in your statement of financial position for your notes receivable would be 507,005 pesos. Okay, simply the principal balance, the remaining principal balance minus the remaining unearned interest income. Okay, let's proceed to year three, class. Let's proceed to year two. Okay, again, another possible question here would be how much will be the interest income for year two? How much will be the interest income for year two? So again, you simply have to multiply the effective interest rate with the remaining principal balance. And as I mentioned earlier, the net balance or the net amount of your notes receivable for a while. Okay. So the principal balance was 507,005. All you have to do is to multiply 507,005. Okay. 507,005 times 12% would give us 60,841 if rounded up to the nearest ones place. Okay, so 60,841. So if you're asked how much is interest income is earned on for the year 2022, our answer would be 60,841. Okay, and if you're asked at what amount will your notes receivable be presented, okay, so again you start with the remaining face value of your notes receivable and deduct the remaining unearned interest income. Okay, so you don't have to start from the very beginning class. You can just start from the balances from the end of the previous year. So, for example, how much was our unearned interest income last year? It was 92,995. And how much have we earned this year? We have earned 60,841. So that means the remaining unearned interest income after 2 years would be 32,154. Okay, and since the question is at what amount will the notes receivable be presented, again, it should just be the principal component, the principal balance. It would be 300,000 minus 32,000, 32,154. 32,154. And that would be our remaining unearned interest income, and then you deduct the 32,154 from 300,000, you would get 267,846. So you might ask the question, why are we not deducting the 32,154 from the 600,000? Okay, why are we not deducting the remaining unearned interest income from the 600,000? Because after 2 years class, the remaining balance on our notes receivable is not 600,000 anymore. Why? Because there was a payment on December 31, because the problem tells us that payments will happen every December 31. So it after 1 year, the balance, the face value or the gross amount of notes receivable was 600,000. After another 300,000 payment, the balance is now just 300,000. Okay, so 300,000 minus 32,154 will give us the remaining balance of 267,846. Okay, so that class, by this time next year, the 300,000 class will now represent the full payment of the notes receivable and the remaining interest of 32,154. Okay, and I think that's everything for problem 6-3. Any question, class? Okay, we'll proceed to 6-4. Gullible Company is a dealer in equipment. On December 31, 2021, the entity sold an equipment in exchange for a non-interest bearing note requiring 5 annual payments of 500,000. The first payment was made on December 31, 2022. The market interest for similar notes was 8%. The relevant present value factors are the following. Okay, so I think one of the challenges in this problem class is for you to choose the correct factor to use, for you to choose the correct PV factor class. Okay, and since the manner of payment here class is in installment, okay, we have a series of periodic payments. The factor that will be relevant here class would be our annuity factor class. Okay, I hope you know that already. If we're dealing with a series of cash flow, then a series of uniform cash flow, then the factor that will be relevant would be your annuity factor. Okay, you use the 0.68 class if you receive a single cash flow at the end of 5 periods. Okay, if you have a lump sum figure, then it would be the lump sum factor that you will be using. But if you have a series of uniform cash flows, then you should be using the annuity figure. Okay. So the first entry would definitely be to recognize the notes receivable class and to recognize the initial balance of the unearned interest income and the corresponding sales figure. So very similar to problem 6-3, the primary difference is that we don't have a down payment here. In 6-3, we had 100,000 down payment. So basically everything is paid through the note, the promissory note issued by the customer class. Okay. So definitely we'll have a debit to notes receivable class and how much man. Okay. It's not directly given, but it should be very easy for us to figure out. The entity sold an equipment in exchange for a non-interest bearing note requiring 5 annual payments of 500,000. So that means total payments that we will receive would be 2,500,000. That should not be difficult to understand. So the amount of notes receivable that will be recognized class as of this on December 31, 2021 would be 2,500,000. And our credit here class would be the unearned interest income and the sales figure. Okay. So because if this was an interest bearing note, then the entire 2,500,000 class would have been credited to our sales. But since the promissory note is non-interest bearing, we now assume that the 2,500,000 that we will receive in total over the next 5 years will be composed of payments of the sale. Okay, so principal payments representing the consideration for the sales transaction and the imputed interest. Okay, the implied interest, the interest that is considered to be that is already understood to be part of the payments. Okay, so what do we do here? We solve for the present value class of the future cash flows to get the principal component, which will represent our sales figure, and the remainder would represent the interest income that we will earn over the next 5 years. Okay. So again, one of the things you're supposed to figure out in this problem is to know that you are supposed to use 3.99 instead of 0.68. Okay. 3.99 multiplied by 500,000. Okay. Why am I just multiplying directly 3.99 with 500,000? If you'll remember in problem 6-3 class, I reminded you not to immediately multiply 2.4018 with 900,000. Okay, I asked you to divide the 900,000 by 3 before you multiply it with 2.4018. Okay, but why in this case, in problem 6-4, yes, Ms. Ontiveros?
Because wala down payment, sir.
Sorry, because,
Wala down payment.
yeah, I, I'm sorry for calling you Miss. I just read your first name. Okay, so aside from that class, because the 500,000 represents already the periodic payment class, it does not represent the total payment. Okay, if you'll compare in 6-3, 900,000 was the total payment that will happen in uh, that will happen in that will happen over the next 3 years. But the 500,000 here is the annual payment. Okay, so that's what I want you to remember, class. If you're using the annuity factor class, multiply it with the annual payment. So be careful with the figure given in the problem. If the given figure is the total, then you have to compute pa for the annual payment. If you're given the annual payment, then it will be fine for you to immediately multiply it with our annuity factor. Okay, so help me here, class, but this should be very easy to multiply. 500,000 times 3.99.
1,994,000.
1,995,000.
995.
995,000. Thank you. Okay. So, and again, this complies with our expectation class. Diba, I told you that the present value is expected to be lower than the aggregate or the total future payments class. Total future payments is 2,500,000, while our present value is 1,995,000. Okay, because we expect it to be lower because the difference will represent the interest component. So if the total payments that we will receive would be 2,500,000, and we know that the present value of these lima kabuok 500,000 will be 1,995,000. Why will we receive 2,500,000 in the next 5 years? Because the customer will be paying us interest in the amount of 505,000. Where did we get 505,000? 2,500,000 minus 1,995,000. Okay, so the complete entry for the date of the transaction class would be 2,500,000. Sorry, debit notes receivable 2,500,000, credit sales 1,995,000, and credit unearned interest income in the amount of 505,000. And these 500,000 class uh, will be earned in the next 5 years. Okay, but for the 1,995,000 class, for the 1,995,000, it will be recognized as a sales already. So meaning this would be considered as an income on for the year 2021, because that's how we apply accrual class. The transaction happened this year. The transaction was completed this year. So the entire 1,995,000 will be considered as an income this year, even though we will not receive the payment yet, even though we'll only be able to receive the payment in installment in the next 5 years. Okay, because under accrual class, as long as it is already earned, then it should already be recognized as an income, regardless of when it is actually paid. Then you would ask, why are we not recognizing the 505,000 as an income this year? Why are we still recognizing it as an unearned income? Because the earning process for interest class is different from a sales transaction. Okay, for sales class, normally if there is delivery, then the transaction will be considered completed already. Then you can recognize your sales revenue or your sales income. But for interest class, as I have repeatedly mentioned earlier, interest is earned through passage of time. Okay, so there has to be gradual recognition of the total interest that you expect to receive from this transaction. Okay, and for the first year class, no need to prepare adjusting entries because the date of the transaction falls on the last day of the period reporting period as well. So no portion of the interest have been earned yet. Let's proceed to the second year. What will happen the second year? On December 31, 2022, we'll receive payment. Okay, and again, the entry to recognize payment class should be very simple. It would be debit cash, obviously, because we'll receive payment, and credit notes receivable in the amount of 500,000. Okay, and the second entry that we'll have to prepare would be to recognize now the earned portion class, to recognize the earned portion of the interest. Okay, and again, how are we supposed to compute for the interest income that is already earned for the year? Are we just going to divide 505,000 by 5? Okay, and it's very tempting class. Okay, 505,000 divided by 5 is a very good figure. It's a closed amount. Normally, students would figure out that they get the wrong answer if bungkag ang amounts. But if you divide 505,000 by 5, you would get a whole figure, 101,000. But again, we are supposed to use the effective interest method. So it should be based on the outstanding balance. It should be based on the remaining principal balance. And you just have to multiply the effective interest rate with the outstanding balance. Okay. So how much was the principal component of the notes receivable class? It's 1,995,000. So multiply 1,995,000 by 8%. Help me here, class. How much is 195,000 times 8%?
159,600,
159,000.
sir.
159,000.
600.
Okay. For a while, class. So interest income would be 159,000. 159,600. Okay. So that would be the first question here. How much would be your interest income for the year 2022? And again, your answer would simply be 8% times 1,995,000. Second question, class, which is actually the requirement in number 2. Determine the carrying amount of the notes receivable in December 31, 2020. Again, just get the outstanding balance of your gross receivable, class, and deduct the remaining unearned interest income. And this is where students will get it wrong, class. It should always be the remaining unearned interest income, class. Okay. So how much was the remaining balance of your gross receivable, class? It should be 2 million only. Okay, I hope you're able to follow. Initially, it was 2,500,000, but since we receive a payment of 500,000, the remaining balance of your gross receivable would be 2 million. Okay, and you could actually just get the present value of these 2 million, class. You'll already get your answer, but since you're not given the factor for 4 periods, you'll have to deduct. You'll have to solve this by deducting the balance of your unearned interest income. Initially, our unearned interest income, class, was 500,000, and we have earned this year the amount of 159,600. So that means the remaining unearned interest income after 1 year would be 345,400. I hope you are following, class. 345,400. And you deduct 345,400 from 2 million, you would get 1,654,600. Okay, and that would be the carrying amount on December 31, 2022. Let's proceed to the second year, class. On December 31, 2023, to solve for interest income, you'll just have to multiply the effective interest note, class, or in this case, it's referred to as the market interest. You'll just have to multiply the effective interest rate with the outstanding balance. Okay. And how much was the outstanding balance? The one we have computed earlier. It's 1,654,600. I will need your help here, class. How much is 8% of 1,654,600?
132,368, sir.
Okay, so that would be your interest income for year 2023, class. Okay. And let's just continue, class. How much would be the carrying amount? How much would be the carrying amount of the notes receivable on December 31, 2023? Again, our procedure would be the same. Either you prepare the amortization schedule, class, or you start with the remaining balance of your gross receivable and deduct the remaining unearned interest income. Okay, on December 31, 2023, the balance of our gross receivables would now just be 1,500,000. I hope you're able to get that also, class. Okay. For a while, class. Just say hi. So we'll have someone sitting in our class for the rest of the period, class. I hope that's fine. Okay. So let's continue, class. Again, the balance of your gross receivable would be 1,500,000, and all you have to do is to deduct the remaining unearned interest income. In the previous year, the balance of the remaining unearned interest income was for a while. Okay, so let's continue with the third year already. We will be at 1,500,000, and we'll deduct the remaining unearned interest receivable. Before it was the remaining unearned interest receivable was 345,400. and we have earned another 132,368. Can you deduct it for me, class? 345,400 minus 132,368. How much will that give us? 213.32?
Yes, sir.
Okay, 213,032. That would be the remaining unearned interest income, and deduct it from 1,500,000. How much will you get, class? I cannot solve it now. 1,500,000 minus
1,286,968, sir.
1,286,968.
968.
And you'll just have to keep on repeating that procedure, class, for the next 3 years. Okay, for interest income for the third year, multiply 1,286,968 with the 8%. Okay, and so on and so forth. Okay, to get the carrying amount, it's simply the gross balance of the receivable minus the unearned interest income. If we're dealing with installment payments, class, you'll have to be careful because your gross receivable would be periodically decreasing. Okay, but if we're dealing with lump sum payments, class, then your gross receivable in the computation for the carrying amount would just be constant. Okay. Okay, let's have 6-5, class. In January 1, 2021, Enigma Company sold an equipment costing 500,000, which had a carrying amount of 350,000, receiving a 125,000 down payment, and as additional consideration, a 400,000 non-interest bearing note due on January 1, 2024. There was no established exchange price for the equipment, and the note had no ready market. The prevailing rate of interest for a note of this type at January 1, 2021 was 12%. Present value of 1 at 12% for 3 periods is 0.7118. Okay, so the primary difference here, class of between 6.5 and the other problems, class, is number one, the entity involved here, class, is not in the business of selling this equipment, class. Okay, this is not a manufacturer. This is not a seller of an equipment. What is being sold here, class, is actually a used equipment, meaning this is an equipment used in the business of Enigma Company, class, which it is selling to another entity. And there's a difference, class, because if you're engaged, if your primary business operation is in the selling of this equipment, then the transaction will be considered as a sales transaction, class. You will recognize sales revenue. But if the entity that is involved, class, is not engaged in selling this kind of equipment, class, then it would be considered as a ordinary disposal, class. Okay, and for disposal of long-term assets, class, normally you will have to recognize a gain or loss on disposal. You will be recognizing a gain or loss on disposal. But for those that are engaged in manufacturing and selling of equipment, then the income that will be recognized will be sales revenue and interest if it involves long-term payment. Okay, so I'm bringing that up, class, because the entry to recognize or dispose the asset, class, would be very different if what is being sold is considered as an inventory or as an item of PPE. In the previous problem, since they are engaged in the selling of those items, what we are selling are actually considered as inventory. But in this case, since we are selling a used equipment and we are not engaged in the business of selling equipment, the entry would involve the recognition of the used equipment. Okay, and we'll demonstrate the difference later on. Second difference class. Problem 6-5 involves lump sum payment. In the previous two problems, we were dealing with installment payment class or periodic payments. But here, the 400,000 note class will be paid once. And it will be paid how many years? 3 years, after 3 years. Okay. No installment payments. There will only be lump sum payment. There will only be a single payment, and the payment will happen after 3 years. Okay. So these are the things you have to take note of, class, so that you will know how to deal with them, class. Okay. The first would be to the requirements here are to prepare the journal entries, class. Okay, so definitely number one would be to recognize the sale. Okay, and this is what I want to tell you, class. If what you are selling is not an item of inventory, if it is another kind of asset class, you will have to completely derecognize the asset and all its related account. What do I mean? Under the cost model, class, the equipment will have a balance of 500. Will have a historical cost of 500,000. Okay, but the problem also tells us that the carrying amount is 350,000. Although we're not yet supposed to know about property, plant, and equipment. But if we're talking about PPE class, the carrying amount is simply the historical cost minus the accumulated depreciation. So what does this mean? If it has a historical cost of 500,000 and its carrying amount is 350,000, that will tell us that there is an accumulated depreciation in the amount of 150,000. And understand, class, that accumulated depreciation is another permanent account. So you will also have to recognize that account. Okay. So those are the first two things I want you to remember. They recognize the equipment account. They recognize the accumulated depreciation account. And since accumulated depreciation account, class, is a credit account, has a normal balance of credit, being a contra asset account, when you derecognize accumulated depreciation, it will have to be debited. And the same is true for equipment. Since equipment is an asset account, its normal balance is debit. So to recognize the equipment balance of 500,000, you will have to credit equipment in the amount of 500,000. Okay. And what else is happening in this sales transaction? We receive a down payment of 125,000. Since we receive cash, we'll have to debit cash in the amount of 125,000. Okay. And since we will also receive a promissory note for the balance of 400,000, we'll also have to debit notes receivable in the amount of 400,000. So far, class, we'll have three debits, class. Debit to cash, 125,000. Debit to notes receivable in the amount of 400,000. And debit to accumulated depreciation in the amount of 150,000. Okay. And so far, we have one credit to equipment in the amount of 500,000. The balancing figure, class, would be shared by, it's wrong to call it balancing figure. Aside from crediting equipment, we will also have to compute for the unearned interest income. Where are we getting the unearned interest income, class? From the 400,000. Why are we saying there is an earned interest income in the 400,000? Because again, since the 400,000 is a non-interest bearing note, there is an assumption that it includes or that it has an interest component. So what do we do to figure out the interest component? You get the present value of the 400,000. Is the 400,000 not yet at its present value? No, because we expect to receive the 400,000 after 3 years. So definitely we expect the value of a 400,000 cash flow 3 years from now to be less. We expect the present value of a 400,000 that is expected to be received 3 years from now to be lesser than 400,000. So we have to get the present value of your 400,000. And here, the problem already gives us one factor, class. So we will know that this will be the one that we will have to use. So simply multiply 400,000 times, help me here class, 400,000 times 0.7118. Um, This should be 200.
84,720, sir.
How much? Sorry, 200.
84,720.
284,720. Okay. So if the face value of the note is 400,000 plus and the present value is 284,720, the 284,720 represents the principal component, which will be included in our computation later on for the gain on sale. Uh, how much then is the total interest that we will earn from this note class for the next 3 years? Okay, simply deduct 284,720 from 400,000. And this should give us 115,280. I hope you're following class. So the unearned interest income would be 115,280. Okay, out of the 400,000, the interest component is 115,280. Okay. So far our entry looks like this class. Debit cash 125,000, debit notes receivable 400,000, debit accumulated depreciation 500,000, credit equipment 500,000, and credit unearned interest income in the amount of 115,280. Okay, but if you compare those two sides class, the debit and the credit, they are not balanced yet. Okay, we would see that the credit side is lacking. Okay, so that this would tell us class that the transaction results in a gain on sale class. If it was the debit side that is lacking, then that would mean the transaction results in a loss. Okay, so please compute for the balancing figure class. How much do we need to credit to the gain on disposal class, to the gain on sales for our entry to be complete class? The gain on sale or the gain on disposal would be the balancing figure here. How much would be the balancing figure class?
59,720, sir.
Okay, that's correct. Okay, 59,720. And that will now complete our entry class. We'll have 3 debits and 3 credits. Now question, why in the other problems class we are not recognizing the accumulated depreciation? We are not even recognizing equipment. Because again, in the other problems class, the equipments that were sold were not recognized as an equipment. They were recognized as an inventory. And since we are not using the perpetual inventory system, no need to prepare an entry to record the sale of inventory. The same is true for accumulated depreciation. Since in the previous problem, the equipment that are being sold are items of inventory, meaning they are not subjected to depreciation. Okay, you only depreciate those that are used as a property, plant and equipment, investment property, and other depreciable asset. But inventory class is not a depreciable asset. So definitely there is no accumulated depreciation, even if we're dealing with an equipment, and normally an asset that deteriorates. Okay, but since we are not using it as an equipment, then we will not be recognizing any accumulated depreciation. But here in problem 6-5, what we are selling is not an inventory, but instead an item of our property, plant, and equipment, which is a depreciable asset. Okay. So for after 1 year class, are we going to recognize payment? The answer is no. We will not be recognizing payment because there is no payment yet. When will the payment happen? Only after 3 years, only on January 1, 2024. But what will we have to recognize on December 31, 2021 class? You will have to recognize the portion of the interest that had already been earned. And again, how do you compute for your interest income? Class, I cannot emphasize this enough, class. Interest income is a very common question, and all you have to do to answer that is to multiply the effective interest rate with the outstanding principal balance or the present value of the promissory note. At the start, the promissory note has a balance of 284,720. So to get your interest income class, all you will have to do would be to multiply 284,720 with 12%. And that should give us 34,166. Okay, I hope you're able to follow, class. Okay. And to get the carrying amount, again, what did we say was the policy, class, for getting the carrying amount? just the gross balance of your receivable minus the remaining unearned interest income. Initially, the unearned interest income was 115,280. How much have we earned during the first year? 34,166. So if we have already earned 34,166 out of the 115,280, after 1 year, the remaining unearned interest income would be 81,114. So you deduct the 81,114 from 400,000. The carrying amount of our notes receivable to be presented in the statement of financial position would be 318,886. And it's important for you to regularly update the balance class, the outstanding balance of the receivable, because that would be the basis of your subsequent interest income. Okay? For the second year, your interest income will no longer be 34,166 because the outstanding balance of your receivable has increased from 284,720. It is now 318,886. So to compute for the 2022 interest income class, it will now be 318,886 times 12%. 318,886 times 12% would give you 38,266. Okay. And if you will be asked how much will be the carrying amount of the notes receivable to be presented in the statement of financial position, again, you begin with 400,000. Now, question, why are we still using the 400,000? In the previous problems, it's always decreasing because again, here, there are no periodic payments. Okay, this is lump sum. You will only have one payment and it will happen at the end of the 3-year period. Okay, so the gross balance of your receivable is not diminishing class, it's still 400,000. So 400,000 minus the remaining unearned interest income. And you will have to compute for the remaining unearned interest income. Last year it was 81,114 and we have earned 38,266 this year. So that means the remaining class would be 42,848. And you deduct 42,848 from 400,000, you would get 357,152. And what does the 357,152 represent? That will be the carrying amount of your notes receivable. Okay. Now, in the final year class, I want you to help me here. How much is 12% times 357,152? Give me the exact figure, class.
42,848, sir.
Is it exact? 357,142 times 12%. 42. Let me check that. 357,152 times 12%. So what I actually get, class, is 42,858. Let me triple check. 357,152 times 12%. So I get 42,858. Okay, you'll notice, class, there's a 10 peso difference, class, from the remaining balance. And in this case, class, do not insist on the 42,858. Okay, your interest, this is where students get it wrong, na, class. On the final year, class, clean everything already. If in the previous year it was 42,848, notwithstanding mahimo siyang 42,858 when you actually compute, to completely erase everything after the completion of the transaction, class, just adapt 42,848. Okay, so that the balance would be zero. Because if we will insist on 42,858, class, magka-negative balance ang atong notes receivable. Okay? But rarely will problem ask you for the final year, class, but just for purposes of actual application in the future, class. If it's the final year, no need to recompute for the interest income. Whatever was the remainder, class, whatever was the remaining unearned interest income before the final year, that will be your interest income for the final year. You will expect, class, a difference, a small amount of difference due to rounding off errors lang, class. Okay? So the balance after January 1, 2024 would be 0, class. But on December 31, 2023, the day before the final payment, the balance, the carrying amount of your receivable would be 400,000. But be careful lang, for your 2023 interest income, although the choices that will be given to you class would not be confusing, do not insist na lang on the multiplication of the effective interest rate and the previous carrying amount. Okay, expect a rounding of error. We will cure all rounding of errors in the final year, so everything would be cleared lang. Do not insist on a different amount.